Okay, everyone, so now we are finally on the board and I'm going to show you the three phases that I said I'm going to explain. So the first phase is my strategy overview. And what we mean by overview is basically I will show you what you need to know and how the strategy works. And I will show you what you need to know in order to implement this strategy in your own trading. So we'll go over the concepts you need to understand for this strategy. So let's dive into it. By the way, you're going to have a link where you can have access to all of these things on the board and you can just go over it and watch it there. You can read everything I'm sharing to you right now because I believe the information that I'm going to show you right now is something very important and you would want to have this link saved somewhere so you can always go back and watch what I've shared with you because I'm going to explain in depth some of the concepts. So the first thing we have to understand for my strategy is the structure. So what is structure? Why do we need it? Why it's important and how to use it? What I mean by structure is the market moves. So impulses and corrections, premium and discount areas, and break structure and change of character. This is what we mean by structure. Later on, I'm going to explain all of this in the slides, so just be patient with me. The next thing I'm going to be teaching you is liquidity. My strategy is fully based on liquidity, so if you don't understand liquidity, then you're going to have a bigger problem. So again, we will explain what is liquidity, why it's important, why it's needed, and then how to use it. So before we know how to use it, we have to understand what type of liquidities are there and how we can trade them. We have internal and external ranges, we have point of interest, buy side and sell side liquidity, fair value gaps, weekly and daily highs and lows, and of course, session liquidity such as Asia session. So some of you might be using London session as well as liquidity so you can trade on New York. And I'm gonna dive into this later on. And of course, inducement. Then I'm going to explain what fair value gaps are and how to use them. So there's different types of fair value gaps. Again, we have immediate rebalance, red delivered rebalance, we have bullish and bearish fair value gaps, and then we have inverted fair value gaps. If you don't know what inverted fair value gaps are, it's basically the opposite of a fair value gap. But I'm going to explain this again later on in this episode. Then, of course, I'm going to be teaching you order blocks such as last up and down candle, how are candlesticks formed in general, so indecision, pin bar candle, and engulf candlestick pattern. And then we have manipulation and distribution, which can be very useful when you're looking for an order block in your charts. Then we move to breaker blocks. Again, as we have fair value gaps and inverted fair value gaps, we have order blocks and breaker blocks. So breaker block is just the opposite of an order block. And I'll explain what I mean later on again. And later I will give you three different examples of how breaker blocks can occur on the markets, such as after a market structure shift or liquidity sweep on higher time frame. And then we have our top-down analysis, or basically our bias. We'll go through higher time frames and lower time frames, see how to analyze the charts on all of these time frames and what to look for on each time frame. And then we have our bias. So bias is something very important in trading because this is what's going to tell you where the price might get next. So there's different type of bias. It's directional bias, liquidity sweep. We have candle bias, alignment, and reactivity. We'll dive into all of these concepts. And finally, we have different market maker models. What we mean by market maker models is price action moves that are happening over and over again over time. So we have the MMXM. So this stands for market maker buy model and market maker sell model. Then we have divergence. This is a correlation between different pairs. And I'm going to give you an example of only the pair I'm usually trading. So this is Euro USD. In this case, the divergence of Euro USD is GBP USD. And finally, we'll have the trading plan. So we'll put all the information, all the concepts in one, and I will show you how this strategy works once you've learned every single concept and technique you need to understand. So first thing we need to understand for strategy is the bias checklist. So higher time frame, lower time frame, and session analysis. We'll go through each time frame and I'll show you what I'm looking for, what I mark on each time frame, and finally why the session analysis matters in this case the most. Then we have our entry checklist, and you need at least 3 or more confirmations of this checklist. So the first thing we have is our higher time frame and lower time frame must align in some kind. So we have our lower time frame premium and discount, which means we'll be waiting for the price to have a reaction on the 15 minutes time frame from our premium or discounted area. Then we have manipulation beyond session open or close, plus buy side, sell side sweep. You might not understand what I'm talking about, but this is just a quick overview of what I'm just about to show you, so don't worry about it. And then of course we have lower time frame key levels such as supply, demand, order blocks, basically areas where we are expecting the price to reach out and reverse or continue or stall. We have our low time frame confirmations such as market structure structure shift. So I'm going to explain you what are the lower time frame confirmations I look before I want to enter a trade. So there's different models such as market structure shift and order block or breaker block. So this is the entry model 1. Entry model 2 is having inverted fair value gap or fair value gap. And finally, entry model 3 is the power of 3. So basically accumulation, manipulation, and distribution, and an optimal trade entry where I can take my position from. Of course, we have candlestick alignment. This is another confirmation for me whether I'm going to take this trade or not. If I have all of these things aligned, I'm going to be looking for a place where to enter my position. So in this case, I'm going to be looking for order blocks, which is indecision candles, or I'm going to be looking for the engulfing pattern, which can give me an indication that this setup is right. And then we have model alignment. So there's 4 different models for this strategy, and I'm going to dive into each one of them. We have the market maker model, where we have something like that. So we have original consolidation, accumulation, and then the price reaches some kind of higher time frame PD array and starts to reverse, creating a market structure shift. And then we are going to be looking for entries around this area or maybe in the distribution phase. So then we have distribution, redistribution, and the price reaches all the way to the original consolidation. This is one of the models I'm trading. So let me show you how it looks on the real charts. Okay, here's a perfect example. We have original consolidation, we have accumulation, prices is going lower. Probably here we have some kind of higher time frame demand in this case. So we have this market structure shift to the upside, price is going up, and then it reverses back to this fair value gap, and then we take our positions, our stop loss a little bit below this fair value gap just to give the trade more room to move, and then we can see the price has reached all the way to this original consolidation. Then we have the power of 3 model. As I said, we have accumulation, manipulation, and distribution phase. So these are the 3 main phases the market has. And in order to make this more reliable, we can simply understand where these phases are going to occur in the market, judging by the candlesticks on higher time frames. Let's say this is our daily candle. Usually we will have our accumulation below the open candle, and the price will go to the low of this candle. And there we can look for the price to start reversing. And the best way to understand where this power of 3 is going to happen is with higher time frame alignment, for example, the daily candlesticks. Now I'm going to explain how all of this works later on once we reach that phase. Let's see how it looks on the charts. Okay, so here we had accumulation, then we had manipulation, manipulating this Asia session high, and the price reaches this optimal trade entry and then creates market structure shift, which then leads to our distribution phase. The next model is smart money model. So basically we will have some kind of accumulation, the price is sweeping some liquidity on the left side, and then the market creates a market structure shift below this ranging cycle. And then we can look for entry using Fibonacci tool. So this is the same picture as before, however, we're looking on the other side of the market. In this case, this trade had multiple confirmations using 2 models. So I'm just going to explain the smart money model right now. We're ignoring this power of 3. So here's what we had. We had this high, the market created a break of structure here and then swept this high. So basically this is our liquidity, and then moved back to the downside, creating this market structure shift or another break of structure. So in this case, what we have to do is find our optimal trade entry, again using Fibonacci tool. As you can see, this is our 78 and 61% on the Fibonacci tool. Price reaches this area and starts reversing. And finally, we have the liquidity model. So the liquidity model is quite similar to the smart money concept. However, here's what's going to happen. The price is reaching higher time frame PD array or lower time frame. So the market is going to be reaching supply or demand. In this case, we have our supply where the market is reaching, and in this case, we're expecting the price to reverse. So what we have to do is look for liquidity sweep, the market sweeping these highs, so basically sweeping the liquidity, and then start reversing by creating market structure shift, and then we can be looking for entries around this area depending on candlestick confirmations. So here's what I mean. We have our 1 hour demand. The price is sweeping liquidity, so sweeping sell side liquidity, reaching this demand, and then quickly reversing by creating market structure shift. In this case, we are either looking for fair value gaps, inverted fair value gaps, order blocks, or break the blocks. In this case, we had fair value gap, so I placed my position in this area right here. My stop loss a little bit below that, so the trade can have some more room to breathe. And as you can see, we targeted our buy side liquidity on the opposite side, and it ended up in profit. So these are the 4 models I'm using in my trading that are helping me manage 60 to 70% win rate and make 10% profit each month. So as important as the entry checklist, is also important our exit plan. Without an exit plan, it doesn't matter how good your entry plan is, it's never gonna work, because in this point you're shooting in the dark. You're in the trade and you don't know where to exit. So this is gonna be a very big problem if you don't know your exit plan, or if you don't have your exit plan. In this case, my exit plan is targeting opposite liquidity, and usually my average risk to reward on each trade is 4, sometimes 5. And it's mainly when I trade reversals. When I trade continuations, it's around 3 risk to reward, and sometimes I even have trades where I reach 8R, 9R, 7R, 6R. So I'm gonna show you how to manage each of these type of positions. Okay, so we're going to the risk management plan. So usually I'm gonna be trading with 1% on each trade, and if I'm in drawdown, I'm gonna be using 0.2%. I'll show you exactly how this works later on, as I said. And if I have one loss or one win and walk away, the day is done. So that's it for me for the day. When my trade is earning 70%, this is my confirmation that I have to move my stop loss to break even. Now, if my take profit is above 5 risk to reward, then I'm gonna take 50% partials when the price reaches 80% of this exact setup. So overall, this is the overview of the strategy, and now we're gonna dive deeper into each concept. First of all, I'm gonna teach you the concepts and techniques you need to understand, and then we're gonna dive deeper into how to use this strategy on each time frame, what confirmations to look for, what kind of price action you're looking for, when do we have days when to take no trades, and finally I'm gonna show you live examples on the charts. So let's get started.